Hi, folks, and welcome back to Super Bowl Sunday edition of Money and Politics. If you have a favorite team, I hope your favorite team comes out on top. And after a remarkable week in the market, I wanted to follow up with you and talk to you about two ideas. They will maybe seem to be in conflict with one another. But before we get started, let me remind you briefly that I'm not a registered broker or financial advisor, and any decision you make to buy and invest in the market is at your own risk. And let's talk about some of those things, because with such an exciting week in the market, where those of us that have invested in TSNP, Humble Financial, had an explosion of growth, you come up with an idea that I'm a little concerned for some people who, one, are thinking, oh man, we made so much money in this stock. What's the next penny stock I can hop on? And then the next penny stock. And I wanted to say, among the things that, one, investing is not a get-rich-quick scheme. And if the first thing that you've ever invested in is Humble, and you've seen this go from whatever, a dime, 20 cents, 50 cents, and it closed on Friday at $1.38, it may be giving you, as exciting as it is, the wrong idea about investing. And I often say, then we're right at this point. Well, when do I sell? And I've often said that when you sell, or the question of when do I sell, is the hardest thing to answer. And that's why I want to say right off the top, as I did, that I'm not your financial advisor. I can try to educate you on some ideas in the market and how to invest, but because I don't know your circumstances, you have to decide that. I also say to people that 90% of learning is emotional. It's one thing for me to talk about doing push-ups, and you understand what a push-up is. But if you start doing push-ups, you feel it. And the emotional reality of doing a push-up is different than the intellectual understanding of doing a push-up. And right now, it was one thing to be saying, yeah, I bought 1,000 shares of Humble, and I've got that. But as we start to go up, and as this starts to become, oh my goodness, I've got a profit of $1,000. I got a profit of $5,000. Should I sell? If you should sell is up to you. The only thing I would say, as I've said before, is you don't have to sell all of your shares at one time. If it's going to make you feel better emotionally, to take some shares off the table, and who knows, maybe it'll go from where it closed at $1.38, maybe it'll go down to $1.10, $1.95. I don't know where it's going. As I said to a friend the other day when we were talking about this, if I knew ahead of time where stock prices were going, I could retire, at the end of the month. I don't know where stock prices are going. I think I know a trend, and I think my idea of Humble is that it's going to grow over time. Are we going to have sell-offs? Yes. We'll have times when it comes back down. If you have available funds, I would say that would be a time to accumulate some more. But I don't know. The other day, the last 1,000 shares I bought of Humble, I think it was Thursday afternoon, I bought 1,000 shares at about 95 cents. And I remember thinking at the time, and I bought it literally within about the last minute of the trading day, that I'm probably buying too high. We'll probably wake up Friday morning and this will be, 75 cents. But what happened? We woke up and it was over $1. I think it opened up at about $1.10 or $1.12 or so. And there you go. I don't know where it's going from one day to the next. So whether you're going to sell or not is up to you. But I would encourage you not to just sell all my shares. I'm going to sell all my shares. Get out, take all that money. You can do it if you want. But I'm going to share a story with you real briefly. This always stuck with me, and I actually saw this story about 30 years ago. And the story was when Sam Walton started his company, Walmart, And I believe it was around, I'm going from memory here, around the mid-60s. He invited friends and family to invest in his company as he was starting. And I don't know what the share prices were, but they were cheap, as you can imagine. Kind of like we are with Humble now. Well, I think it was CBS News did a story on this guy that had been a friend of, and probably was still a friend of Sam Walton's. And this story ran about 85, 86, somewhere in that area. So the company, Walmart, had been around at that point for about 20 years. The funny thing is, this guy, around 1968, who had been one of the early investors in Walmart, sold all of his shares to buy a riding lawnmower, that he might have paid $500 for. And the story was that CBS did that 20 years later, the guy still had the riding lawnmower. He wouldn't get rid of it because, as he explained to the reporter, that riding lawnmower cost me $1 million. Had he held on to those shares in the mid-'80s, those shares would have been worth $1 million. So I share that, number one, as a cautionary tale. When you get in the early game of a company, it might be appealing when you go, oh my goodness, I'm up $1,000, I'm up $2,000, whatever it is. I would encourage you to try to take the long run if the company is a solid company, if it has a viable product, if it has good management. And I would say, correspondingly, don't just buy some shares of stock because it's cheap. And this is one of the fears I have for those of you who start investing with Humble, because it is a penny stock, as if penny stocks are necessarily the way to go. Humble is the first penny stock I've looked at in 30 years. And I just don't want you all to get the wrong idea. Let me show you what investing is like. It's like growing corn. That's what investing's like. You go out and you plant your seeds and you wait for it to grow. You don't plant seeds of corn and go out the next day or a week later or 2 weeks later and think you're going to be picking ears of corn. That's not how it works. But I'm afraid that some of you are getting that idea that that's how it is. You go in the market, it's get a rich quick scheme. It's like going to the casino, bang, bang, bang. And, I responded to one person who wrote in and made a comment, and I said, it's one of the hardest things to do as an investor is after you've planted your seeds. And if you've invested in TSP, at the early stages when it was below $1, one of the hardest things to do is just to sit back and let it grow. Let it grow, folks. There's your field. You've planted your seeds. Let it grow. And we might get a sell-off. We might have it go down. But is it going to stay down? Is Humble not going to grow? I mean, they're just starting to come up with their products and all. So on Humble, that would be my advice. If you need to sell some to pay some bills, or if you emotionally just want to be able to say, I took $300 out of the market, but I still got 20,000 shares or whatever, I'll leave that up to you. The other thing I'd like to talk to you about is sometimes we get just the opposite. We get people who are accustomed to growing their money too slowly. And I've run into that problem. I had a friend who I went to high school with, a woman who, her mother, her dad had been a professional person and had died about 20 years ago. 25 years ago, and her mother was elderly, and her mom didn't know how to invest, and my friend who I went to high school with didn't know how to invest. So she called me up and said, this was around 2015, I've heard the stock market has been up 6 years in a row. How come my portfolio isn't growing? And I said, well, what's in there? What do you own? And she goes, I don't know. And this is one of the reasons that I've started this channel. Because there are certain people, and actually more than you would imagine, who have a lot of money in the market because they inherited it or whatever, just like in this instance. And they don't know the first thing about investing, and they don't know how to grow their money, how to put together a portfolio. I'm giving you an overview right now. At a later time, I'll go into more detail on some of these things. But, how many times have you heard, put your money into Coca-Cola, because that's the way to go. It's a safe thing. It's got a 3% dividend. When I looked at my friend's portfolio that her mother had, and her mother was in her 90s, has since passed away, but she said, well, why isn't my portfolio growing? One of the big reasons was they had way too much money in mutual funds, and I am not a fan of mutual funds, and I'll probably do a different story on that, because there's better ways to invest. The other thing is they had way too much money in Coca-Cola. Now, who on the planet hasn't had a Coca-Cola? Where are you going to grow the company? And let's contrast that with something like Humble. Humble's a brand new company. They're rolling out their products. You can see why they would grow. So we're talking about a concept that I would refer to people as the velocity of money. How fast do you want your money to grow? And I would say you want it to grow fast, but you have to have realistic expectations. So I always like to use analogies instead of filling people up with a bunch of jargon. Let's say we're going down the highway, and the highway has 3 lanes of traffic. And you come up behind this guy that's going 55 miles an hour. And the other lanes are open, and you're in a hurry to go somewhere. So what do? Do you stay behind the guy going 55 miles an hour? No, of course not. You pull over into a lane where you can go faster. Investing is often that simple. But sometimes you're going to get advice to get into something that is allegedly the way to go, but it's going to make your money just stagnate. When my friend called me and I looked at they had a major position in their portfolio in Coca-Cola, and I'm using that as an example, not to pick on that. But I still remember 5.5 years ago, October of 2015, when I took a look at her portfolio as a favor. And no, I don't take money, by the way. As I say, I'm not a professional advisor. But the price of Coca-Cola was $45 a share right then. And, the other day, I saw Coca-Cola go by the screen as I was watching the investment channel, and it was at $48 a share. So in 5.5 years, it's gone up $3. I mean, folks, that's just ridiculous. And yet, how many times do we see this all the time, that people put you in things that just aren't going to grow? Let me show you briefly here. I often say, as I've said before, you can go to Yahoo Finance and you start off with a chart, and the benchmark we use is the S&P 500. 500 of some of the largest companies, not only in America, but in the world. And this is the performance, and I typically go to 5 years. So let me bring that up. This is the 5-year performance of the S&P 500. You see that major dip here. That's where COVID came out last year. But let's go back up to Coca-Cola, and again, you can do a comparison chart as you see me doing. So KO is Coca-Cola, and I'm going to make this red so we can see it. And bang, look at this. So this is a 5-year chart. Now, which do you want to have your money in? The Coca-Cola over the last 5 years or the S&P 500? And there's 2 things here. One, Coca-Cola is not performing the way we want. It's grossly underperforming the S&P 500. And secondly, Coca-Cola is, anytime you buy just one company, you have a one company risk. When you buy the S&P 500, you're diversified by 500 different companies. I don't think Coca-Cola is going to go broke, but any company could go broke. The S&P 500 will never go broke. The S&P 500 can go down, and we see it going down here what COVID did, but guess what? Coca-Cola we see went down too, didn't it? So you're not going to be protected from downturns just because you're in a so-called stable company like Coca-Cola. You're better to invest in something like an ETF and as I've noted in some other videos, the fees on an ETF like the S&P 500 are far lower than the fees that you get in the mutual fund. So this is where, again, when you look at these two charts, it makes a huge difference. If your investment is growing at 17% over the last 5 years, as we see with Coca-Cola, or if your money grew at 106%, as we see in the S&P 500. Now, what if we have, again, compare it to the NASDAQ. The NASDAQ, and you can buy, that's the NASDAQ 100. It's predominantly all tech companies, and the NASDAQ doesn't always outperform the broader market, but it typically does. So let's make that a purple so we can see it. And boom, look at the difference right there. Up 217% over the last 5 years. Now, do you want to be in Coca-Cola? I don't think so. So this is safe investing, and it grows. It's not a get-rich-quick scheme. It is growing your money. But again, I want you to understand you can be in the slow lane. The red line there, that's a Coca-Cola, and there's all kinds of stocks that go like that. Or you can be in the faster lanes. They are not crazy fast. They're stable. The S&P 500 up 106% over 5 years. The NASDAQ up over 217% over 5 years. And this is what we call the velocity of money, my terminology that I use to say, you want to grow your account not in a ridiculously risky way, but you want to be able to grow your account in a way where your money is consistently going to grow. And to that end, it's going to be like growing corn. Plant your seeds and then let them grow. And so to that end, folks, something like Humble, which is a great individual stock to own, but even there, you don't put all your eggs in one basket. You know, it should be part of your portfolio, but you should understand that we want to have some stability in our portfolio, and then we also want to have some individual stocks that are going to give us some speed. But if we're all in something that's, all of our money is in something like a Humble, the problem is you're going to panic. You're going to panic because it's going up, and you're afraid that, oh my gosh, I've now got so much money that if it goes down, I'm afraid I'm going to lose it. So you sell when you shouldn't sell, or, you know, sell some of it if you want. Or if we get a retracement and the price of Humble goes down, you're going to panic that it's going back to zero, and you sell when you shouldn't sell because it's, you know, down to 70 cents or 75 cents. You can learn a lot about the analogies of the highway. Don't be driving in the slow lane, and don't be thinking that when you buy a stock, whether it's a stock that's $5, $10, $20, or a stock that's a penny stock, think of corn. Plant your seeds and let them grow. Okay? I hope that helps, folks. As always, I appreciate you watching, appreciate you making your comments, and don't forget, if you like it, give us a thumbs up, subscribe, and share the videos so that we can educate others. I so greatly appreciate it. As I record this on the Sunday, Super Bowl Sunday, on Friday, we hit over 1,000 subscribers. We did a lot faster than I thought we would. And we're up a lot since then, too, so people continue to watch the videos. I just appreciate it so much. I hope over the course of time that you're going to get the fundamentals. And one last thing, let me say, because sometimes people think this is, you know, you're going to use math. This is over my head. It's going to be difficult. You are more than smart enough, okay, to make money in the market. You are more than smart enough. Don't think this is complicated, and that's why I like to use these analogies. Once you get the basic ideas, you can invest responsibly, and you can grow your account. You do not have to pick. This is what I have proven to people. You do not have to choose between growth and safety. You can have both. It just depends how you structure your portfolio. And the one last thing, don't forget, try to always keep some cash in your account. That also is it's the same reason that when I drive somewhere, I have a spare tire in the car, because I have safety with that spare tire. Keeping cash in your account is going to help give you a foundation to your portfolio. And then if we do have a downturn and you want to buy something, you've got cash to draw on. I've gone longer than I intended to, but I'll say goodbye. Thanks again for watching, and safe investing. We'll see you again later in the week. Take care.